Retail traders frequently hunt for a flawless mathematical formula, an indicator capable of perfectly calling the exact moment a market peaks or bottoms out. Financial markets operate as highly turbulent, chaotic systems. To survive that noise, the human brain desperately seeks a mechanical rulebook. If you open any standard charting software, you will find hundreds of proprietary tools: MACD, RSI, stochastics. They appear distinct, but they all crunch the exact same open, high, low, and close price data. Looking at this candlestick chart, we can stack these three indicators directly below the price action. Their outputs reveal a glaring redundancy. Observe the exact timing of these crossovers. The signals trigger simultaneously across all three sub-windows. The formulas may differ, but they are all calculating a single metric: the rate of change of the price trend. Relying on one of these indicators on a single time frame creates a trap. You receive the signal only after the price has already moved, locking you into terminal lag. The structural solution to this lag requires a completely different approach to the data, a method known as the dual time frame momentum strategy. A professional edge does not come from discovering a secret mathematical formula. It comes from the mechanical alignment of multiple time frames. To use momentum correctly, we must start with a rigid axiom. Indicators track momentum trends. They do not track price trends. Ignoring this rule leads directly into the most common trap for intermediate traders: price momentum divergence. This 60-minute chart shows a clear divergence. The price trend line traces higher highs, while the oscillator below it descends, tracing lower highs. To understand why the indicator falls while the price climbs, we have to look at the velocity of the move. As the ascending price line curves and flattens, the speedometer needle drops. The deceleration matches the downward slope of the oscillator below it, step for step. The price is still advancing to new highs, but the mathematical rate of that advance has slowed down. A trader who shorts this market simply because the oscillator crossed downward will find themselves instantly trapped. The broader bullish trend is intact. It has merely taken its foot off the gas. A momentum reversal strictly signifies deceleration. It is never a guaranteed directional price reversal. Because momentum can diverge from price, we need a secondary filter to authorize when a trade is actually viable. This gives us the first rule of the dual timeframe strategy. The higher timeframe establishes a non-negotiable directional macro bias. We must separate the macro trend from the micro trigger. The top half of this screen tracks the daily higher timeframe. The bottom half tracks the 60-minute lower timeframe. By identifying a period where the daily momentum is clearly bullish, we authorize a specific multi-week window for trading. Rule 2 dictates that the lower timeframe is used exclusively to isolate the exact execution trigger. We filter out the noise by taking only the 60-minute bullish crossovers that fire strictly inside our authorized green daily window. This architecture mathematically forbids you from shorting the market during temporary 60-minute pullbacks while a larger macro bull run is underway. High probability setups only exist when the micro trigger fires in absolute alignment with the macro bias. Aggressive, high-velocity trends introduce a paradox. Normal oscillator cycles fail, and the indicators hang at their extreme edges for long periods. On this daily chart, a steep bull trend drives the stochastic indicator straight into the 75% overbought line, where it remains pinned completely flat. In a relentless directional move, the mathematical bounds of the oscillator are exhausted long before the actual price trend stops climbing. This creates a strict operational constraint. If the higher timeframe bias is bullish, but the indicator is already pinned in the overbought zone, future upside potential is statistically limited. This yields an actionable rule matrix. When the higher timeframe is bullish and overbought, no new long positions are permitted. The exact inverse applies during bear markets. If the higher timeframe is bearish and oversold, new short positions are restricted. Overbought and oversold levels are not triggers to reverse your position. They are boundary limits designed to restrict new capital exposure when a trend is mathematically exhausted. The idea that there is a static, universal look-back setting for an indicator is a myth designed to sell retail trading systems. Look-back periods must be dynamically calibrated to the specific, real-time volatility of the asset you are trading. We can see this clearly by running the exact same daily price data through indicators set to 21-day, 13-day, and 8-day look-back periods. The 8-day period is too short. It generates chaotic, mid-range crossovers that trigger false execution signals and constant whipsaws. The 21-day period is too long. It suffers from extreme signal lag, generating reversals only after the price has already moved significantly away from the optimal pivot point. The 13-day calibration strikes the necessary balance. The indicator cleanly tags the extremes exactly at the price pivots, eliminating mid-range noise entirely. As market volatility naturally expands or contracts over time, professional traders continuously recalibrate these settings to match the current data. A mechanical system can protect your capital only if its mathematical parameters are strictly aligned with real-time market conditions. We can take this theoretical architecture and apply the complete dual timeframe matrix to the messy reality of live charts. Looking at this daily bond chart, we begin by establishing our baseline macro conditions. This period operates under a strict, undeniable bearish weekly bias across the entire screen. Within that macro trend, we isolate a sequence of 5 distinct lower timeframe bearish trigger points. Trigger points 1, 3, and 5 generated massive downward price acceleration immediately following the signal. These 3 specific setups satisfied every rigid parameter. The micro momentum crossed downward, while the macro momentum was heavily bearish, allowing the trader to capture the full weight of the broader trend. But trigger points 2 and 4 failed. Despite structurally flawless setups, the price moved sideways or slightly against the position. Mechanical perfection is an illusion. In any trading system, statistical failure is guaranteed. The dual timeframe filter does not predict the future with certainty. It exists to mathematically skew your win rate, isolating high probability trades while ruthlessly minimizing your capital exposure.